Welcome to the Deep Dive, where we streamline your intelligence, by extracting the most critical insights from today's market snapshot.
We've got a lot of sources you sent in, a deep cross-section of macro equities and crypto volatility.
And our mission is simple. Cut through all that noise and deliver only the knowledge that actually matters.
We're dissecting the financial mood heading into the final week of the year, really based on that December 25th data. And this market is, well, it's defined by a pretty precarious balance.
A balancing act, for sure.
It's being pulled by three powerful, distinct, and honestly, often contradictory forces.
Okay, so let's frame this for everyone listening. The takeaway is a cautious, event-driven approach, right? So what are those three major forces creating all this tension?
So force number one is the specialized liquidity management tools being used behind the scenes by the New York Fed.
Okay, the plumbing.
The plumbing. Second, you have this high-stakes, almost binary news flow coming out of the AI sector, specifically everything to do with NVIDIA.
And the third?
And third is that persistent kind of self-contained risk from all the leverage and volatility inside the crypto ecosystem.
That paints a really clear picture. You have systemic adjustments happening quietly right alongside these huge headline-driven swings. Let's start with the foundation then, the macro view.
What if that sets the anchor?
We have to talk Treasury yields.
Absolutely. And the Treasury market is giving us some mixed signals here.
Okay.
The long end, the benchmark 10-year yield is showing relative stability. It's oscillating very tightly in that 4.10 to 4.28% band.
Last I saw it was around, what, 4.16?
Right around 4.16%. And that suggests the broader market is, let's say, comfortable with the medium-term inflation outlook.
That comfort feels a bit misleading, doesn't it? Because if the 10-year is the institutional calm, then the 2-year yield is like the market's nervous system.
That is a perfect way to put it. The short end, the 2-year, is hovering near 3.48 to 3.54%.
And that's where the sensitivity is.
It's extremely high sensitivity. Not just to big policy announcements, but directly to the technical tools the New York Fed is using to manage the daily flow of cash. It's where the rubber meets the road for liquidity.
And behind all this is still the specter of inflation. The Fed's core job hasn't changed.
Correct. Inflation is still on its, gradual and painstaking descent, but it remains stubbornly above that 2% target.
And jobs are still pretty strong.
Generally robust, yeah, even if it's cooling a bit.
Yeah.
And that combination sticky inflation plus a resilient job market, it basically means the Fed is handcuffed to a, quote, gradual and cautious path.
So any rate cuts are going to be slow, data-dependent, and probably not that big.
Exactly, which is why the market is hyper-focused on everything the Fed is doing, even these, technical maneuvers.
Which brings us right to the centerpiece of the macro discussion, RMP, reserve management purchases.
Right.
This is not the headline-grabbing QE that we all remember from a decade ago. So let's break this down. What is RMP, and why does it matter right now?
What's fascinating here is really getting the nuance. So RMP kicked off around December 12th.
Okay.
And it involves the purchase of roughly $40 billion in short-term securities in just the first month.
40 billion is a big number. When people hear Fed buying bonds, they immediately think QE.
They do. And that was about suppressing long-term rates, stimulating the economy.
But RMP is different.
RMP is fundamentally different. It's not economic stimulation. It's financial plumbing. It's a short-end reserve management operation.
So think of it less like a cannon and more like a specialized tool.
Precisely. QE was the cannon aimed at the long end of the yield curve. RMP is more like a plumber, carefully adjusting the water pressure overnight.
And they're buying short-term bonds specifically.
Specifically, to manage the distribution of reserves and make sure banks have enough cash without messing with the Fed funds rate target.
So it's designed to oil the machine, operational stability, not policy expansion.
You've got it. It's technical short-term bond buying.
Yeah.
It's about fine-tuning the system's liquidity.
Okay, so with that cautious, liquidity-managed backdrop set, let's see how this is affecting risk assets.
Right. How does this translate into the high-stakes world of equities?
Exactly.
Well, we're seeing a kind of bifurcated market. The broad indices are pretty stable. You look at the Vanguard S&P 500 ETF, VOO. It's holding steady near about $635.
Suggesting some broad institutional comfort.
But the real energy, and frankly, the real risk, is all concentrated in growth and tech.
That's where the volatility is?
That's where it lives. The Invesco NASDAQ Q100 ETF, QQQM, is near $257, but it shows much higher short-term swings.
Because the market is just laser-focused on a few key events.
High-impact events tied to a handful of companies, mostly in the AI space.
And the single biggest event right now is centered on NVIDIA.
The most important stock in the current cycle, arguably.
So what's the specific news that's moving NVIDIA right now, which is trading what, in the $188 to $189 range?
Yeah, it's entirely dependent on news around its H200 chip export licenses to China. We've seen some media reports that are hinting at positive signs for approval.
An approval that would let them start shipping before the Lunar New Year.
That's the goal, sometime around February 2026.
And the potential revenue from that is just massive. It would be a colossal stimulant for the entire semiconductor sector if it happens. But what's the catch?
The massive caveat is the intense political and regulatory scrutiny. This isn't just a Commerce Department call.
Congress is involved.
Congress is demanding transparency on these exact licenses. So the market knows that even if approval looks likely, the risk of a political roadblock or a last-minute reversal is still very high.
And that potential swing between massive sales and strict ban is what's causing all that volatility.
It perfectly encapsulates the whole tech environment right now. You have this enormous technological opportunity colliding head-on with geopolitical restrictions.
We see other tech leaders following their own drivers, too.
For sure. I mean, Tesla TSLA near 485, that's purely a story about margins, sales, price wars.
And Meta
Near 660, 668, is successfully using its AI products to boost its core advertising business. And then you have Google in the 310 to 316 range, still leaning on its ad ecosystem and its own AI apps.
But all these moves are still kind of dependent on the broader risk appetite, which is being driven by that NVIDIA outcome.
Exactly.
Okay, let's transition from the high-risk tech world to the truly high-leverage crypto market. If the VIX represents the market's fear, what's the crypto fear gauge telling us?
Well, the standard volatility index, the VIX, is relatively contained, sitting in that 14 to 17 range.
Sure, the stock market is sensitive, but it's not panicking.
Not panicking, no.
Yeah.
But the crypto market is telling a far, far more dramatic story.
How dramatic are we talking?
The crypto fear and greed index is languishing deep in the pessimistic zone. We're talking fear, or extreme fear, with an index value down around 20 to 25.
And the reason these two are so divorced is that crypto risk is mostly self-contained.
It is. The extreme fear signals weak, short-term sentiment, but crucially, it flags very high liquidation risk.
Because of all the leverage?
Massive amounts of embedded leverage. So the volatility isn't necessarily new people coming in, it's over-leveraged traders being forced out.
That makes sense.
It does. Bitcoin is oscillating around $87,000 to $89,000. Ethereum is holding near $2,900 to $3,100.
And the main volatility driver for both is just leverage liquidation.
That's it. When prices move even a little, margin calls cascade, forcing these massive, often automated sales that just push prices down further. It's a cycle.
Caution is paramount there. But beyond just price action, there's some interesting news in the stablecoin space with Circle.
This is a major structural shift. Circle is getting a lot of attention for its international compliance work. They just got key licenses in ADGM.
Abu Dhabi Global Market.
The Abu Dhabi Global Market. For anyone listening, ADGM is a major international financial hub, and it's known for its really rigorous regulatory framework.
So this move into the Middle East makes the internationalization of USDC a really hot topic.
It signals that regulatory acceptance, not just speculation, is driving global adoption.
Okay, before we synthesize all this, let's quickly check in on two major cross-asset hedges. The US dollar index, DXY, and the BTC gold ratio.
Sure, the DXY is relatively firm, trading between 97.9 and 98.6. A firm dollar generally acts as a headwind for commodities.
And that famous ratio, Bitcoin versus gold. How's the digital store value comparing to the traditional one?
So the BTC to gold ratio is sitting at about 20 right now.
And that's based on BTC near 87K and gold around 4,300 an ounce.
Correct, and that ratio has pulled back quite a bit since late 2024. Gold has maintained its strength as that traditional hedge, while Bitcoin has retracted a bit.
So in times of extreme uncertainty, institutional money still favors physical safety.
It seems so, yes.
Okay, let's tie this all together for everyone. We have quiet liquidity engineering, a huge binary event in tech, and a leveraged pressure cooker in crypto. What is the key insight?
The critical insight is that this market is entirely focused on confirmation and event realization, not broad economic trends.
So it's not about the big picture right now.
Not right now. It's the combination of the NY Fed's RMP, the specific risk reward of the NVIDIA news, and that high leverage in crypto. All of it is creating a market that demands surgical precision and, confirmation before anyone acts.
Okay, so given that intense focus, what's the recommended strategy? Let's give our listeners some clear steps.
The strategy has to synthesize caution with opportunity. So first, maintain liquidity. Use dollar cost averaging for broad indices like VOO and QQQM on dips.
But keep cash ready.
You absolutely need cash ready for when the inevitable pullback or confirmation event happens.
And how do we hedge against that quiet macro risk from RMP? That's something a lot of people might overlook.
We hedge against RMP disruptions by allocating a small tactical slice to short-term bonds, high-quality money markets, or gold.
What's the logic there?
It's simple. If the Fed's plumbing adjustment goes wrong, it's the short end of the curve that will seize up first. So these assets are a safe harbor against that specific kind of disruption.
And for the high-stakes NVIDIA bet, we know it's a binary risk.
You treat the H200 China news as confirmed only when you see material evidence.
Like what? Confirmed orders?
Confirmed orders, regulatory filings, verifiable shipping announcements. If that materializes, that is your actionable entry point. Do not trade on rumor here.
And on the flip side, be ready with stop losses.
Be prepared to strictly adhere to them if things go south.
Finally, the warning on the crypto side.
Avoid high leverage in core assets like BTC and ETH, especially with the fear index where it is.
And what about these new tokens, the HYP or pre-stocks?
We have to clarify the extreme risk there. These are often highly speculative, newly minted tokens that might not have full contract audits. They carry significant rug pull risks.
So extreme caution.
Extreme caution, zero leverage, and only minimal, fully disposable capital should be allocated there.
That analysis gives a crucial roadmap for balancing these different kinds of risk.
We hope it helps you stay ahead of the curve.
And that brings us to our final provocative thought for you to chew on this week, and it builds directly on that RMP discussion we had earlier.
It's a question that is really dividing Wall Street and academia right now.
Exactly. The big question is this: is the New York Fed's RMP operation purely a technical short-term mechanism for financial plumbing, or should we view it as a kind of quasi-balance sheet expansion?
A form of soft QE that the Fed is just consistently relying on.
And if that latter characterization takes hold, that the Fed is quietly expanding its balance sheet through these technical tools, what does that imply for medium-term asset allocation?
Specifically, if the market starts to believe the Fed has found a permanent, quiet way to inject liquidity.
How should investors adjust their expectations for long-term interest rate stability and, the future performance of risk assets? It's a dynamic that's really worth exploring as we head into the new year.
A vital question for every informed investor. Thanks for joining us for this deep dive into the December 25th market snapshot.
We'll see you next time.